Listen to me carefully, because what I'm about to tell you is not just news, it's a wake-up call. The kind of message that shakes you, wakes you and forces you to look at the system with open eyes. They tried to control it, they tried to cap it, they tried to stop the momentum at 65. But when something is rising with truth, pressure, and power behind it, nothing can stop it. Not banks, not regulators, not algorithmic traders, no one. And now, with the price pushing towards 67.3, the entire market is bracing for what insiders are whispering about a Monday panic. The level of 65 is not just a number on a chart. It is a pressure point where the entire market structure momentarily reveals itself. When price approached this zone, every major participant, from high-frequency trading desks to institutional short sellers, understood that this wasn't a casual resistance. It was a structural checkpoint, the kind of level where hidden strategies either succeed in suppressing momentum or crumble under rising demand. And the most fascinating part is how quietly yet aggressively the defense of 65 was attempted. The moment the price tested that level, liquidity thinned, spreads tightened unnaturally, and algorithmic sell walls appeared with precision timing. These aren't coincidences. These are coordinated signals of a market desperately trying to prevent momentum from spilling over. But here's the hook. Whenever a market tries this hard to stop a move, it inadvertently exposes how vulnerable it already is. You don't build a wall unless you're afraid of what's on the other side. And the resistance at 65 showed exactly that fear. Every attempt to push the asset down, every sudden sell-off, every microsecond level quote change, was a sign that the market makers and short position holders were operating from a place of defense, not dominance. This level becomes even more interesting when viewed through the lens of order flow economics. At 65, the aggregated short interest begins to tilt into risk territory. Margins tighten. Liquidity providers start reconsidering exposure. Market makers who previously benefited from controlled volatility begin to recognize the possibility of slippage, cascading orders, and forced hedging. It is at this exact intersection between fear and forced reaction where the real economic pressure builds. The psychology of the market shifts from confidence to caution, and then very subtly to panic. And this is where the deeper mechanism kicks in, the illusion of control. Institutions often try to create the appearance of stability by defending key price levels as if the market will obediently respond. But markets are not built on obedience. They're built on pressure, on probabilities, on the unstoppable force of supply-demand imbalance. So the harder they pushed at 65, the more determined buyers became, because every artificial suppression creates pent-up demand. Every forced sell wall makes patient investors more confident. And every attempt to halt growth signals that something valuable, something potentially explosive, is being hidden. This is the exact moment where momentum traders, algorithmic systems, and institutional analysts begin recalibrating their expectations. They see the wall, but they also see the cracks forming within it. And when a resistance level requires this much effort to defend, traders know one thing: the breakout, when it happens, will not be soft. It will be violent, swift, and undeniable. The economic significance of 65 lies in the compression it creates. Think of it like a spring. Every downward push compresses the structure tighter. Every attempt to force price movement downwards only increases the potential upward reaction. And once that compression reaches its limit, the release becomes unavoidable. This is why traders watch levels like 65 with sharp focus. They reveal intent, strategy, and weakness all at once. And here's the real hook: the market only fights hardest at levels that matter most. If 65 didn't threaten major positions, they wouldn't defend it. If the move above 65 didn't unlock losses, margin triggers, or a shift in market control, they wouldn't care. But the intensity of resistance tells the entire story. It was not about stopping short-term movement. It was about preventing a structural break, a moment where the market no longer listens to the institutions trying to hold it back. That is why the battle at 65 was so fierce. Because once that level breaks cleanly, the narrative changes. Control weakens, confidence shifts, and the market becomes something the suppressors fear most: unpredictable, uncontained, and powered by real momentum. When the price moves above a 65, something fundamental shifts beneath the surface, something traders can feel even before they can fully explain it. Short positions, which were comfortable and profitable below that level, suddenly step into a zone where risk begins to accelerate exponentially. This is the invisible tension point where the market's balance changes, not just mathematically, but psychologically. And here's the hook: short sellers don't fear losses, they fear momentum, because momentum exposes them faster than any analyst report or economic forecast ever could. A short position is built on confidence: confidence that the price will fall, confidence that liquidity will hold, confidence that someone else will take the loss first. But all that confidence evaporates the moment price breaks above a defended level. At 65, the shorts weren't just betting on decline, they were defending the illusion of control. And when that level finally gave way, their entire strategy entered a zone where every tick higher became a reminder of exposure they could no longer hide. The mechanics behind this are brutally elegant. As price rises above a 65, every short seller must reassess their margin requirements. Leverage amplifies losses faster than most expect. A position that seems stable at 63 suddenly becomes a liability at 65.50 and a threat at 66. This is where the true economics of pressure begin to unfold. Brokers tighten thresholds, algorithms detect imbalance, and risk engines quietly shift into protective mode. The result is a market where every inch upward feels like a mile to those trapped below. It's not just numbers moving on a screen, it's fear migrating through institutions like a silent wave. And fear is contagious. When one major desk begins reducing exposure, others notice. When stop losses start triggering for one fund, the ripple impacts everyone still holding open short positions. What looked like normal price action becomes a chain reaction of forced decisions. And here's the more powerful hook: the market always punishes hesitation, especially from those betting against the trend. Above a 65, short sellers find themselves in a tightening corridor. Each uptick adds pressure. Each failed attempt to push price back down reveals exhaustion. And exhaustion is the enemy of manipulation. When shorts begin closing positions to avoid larger losses, it doesn't calm the market, it accelerates it. Their buy backs add fuel to the exact move they tried to suppress, creating a feedback loop that becomes harder and harder to escape. This rising pressure also exposes another truth: liquidity isn't guaranteed. When too many traders try to exit the same door at the same time, the door narrows. Slippage increases. Market makers widen spreads. Suddenly, closing a losing position becomes infinitely more expensive than opening one ever was. This is where panic quietly begins, not in headlines, but in trading rooms, in margin dashboards, in risk management models blinking with red alerts. Once above a 65, the shorts no longer control their destiny. The market dictates it. Every minute of price stability above that threshold signals to algorithms and large buyers that the path upward has weakened resistance. What was once defended becomes a launchpad. And for short sellers, that shift is devastating, because there is one rule that never changes: the market can stay irrational longer than a leveraged position can stay solvent. This is why the move above 65 matters so deeply, not because of the number itself, but because of the psychological unraveling it initiates. You can suppress price for a while, but you cannot suppress truth. And the truth is simple: once shorts lose control, they start paying for it with every breath of upward momentum. Their fear becomes the market's energy, their losses become the fuel, and their retreat becomes the confirmation that the breakout is real, powerful, and only just beginning. The price level of 67.3 is not just a technical marker, it is the point where the entire structure of the market shifts from controlled movement to uncontrolled acceleration. This is the kind of threshold that traders study, analysts quietly acknowledge, and institutions fear long before price gets anywhere near it. Because once this number is touched or broken, the market stops behaving like a calm, predictable system and starts acting like a chain of reactions waiting to ignite. And here's the hook that sets the tone for everything that follows, or 67.3 is the price where decisions stop being strategic and start being survival-based. Every market has what professionals call a structural breakout point, a price where the underlying mechanics of trading begin to change direction automatically. At 67.3, exactly that mechanic wakes up. It is the point at which stop-loss orders placed by short sellers start triggering in clusters, forcing them to buy back into a rising market. It is the point where buy signals embedded within algorithmic trading systems activate without hesitation. It is the point where chart patterns confirm a full breakout, signaling technical traders to enter aggressively. And the most powerful part, all of these triggers happen simultaneously, creating a storm that feeds on itself. What makes this price even more fascinating is how it interacts with trader psychology. Below 67, markets feel manageable even if they're moving upward. There's still the illusion that pullbacks are possible, that control can be regained. But when the chart prints 67.3, that illusion cracks instantly. Traders who once expected a reversal begin questioning their assumptions. Funds that remained confident in their bearish positions start facing pressure from risk managers. And institutional desks start calculating exposure not in hours or days, but in minutes. This is the moment where emotion slips into what used to be a rational strategy. Above a 67.3, the market enters what professionals call a confirmation phase. The price action isn't just moving, it's proving something. It's confirming that the momentum wasn't temporary, the buyers weren't weak, and the defended price levels weren't enough to contain the move. And once confirmation sets in, traders who were waiting on the sidelines jump in rapidly, adding volume at the very moment when liquidity starts tightening. This is the perfect recipe for acceleration, the type of movement that looks smooth on charts but feels chaotic to anyone caught on the wrong side. Another important dynamic emerges at this level: forced participation. Not voluntary trading, not discretionary moves, but trading that must happen because the system demands it. Derivatives tied to volatility begin recalibrating. Options market makers start hedging exposure by buying the underlying asset. Trend-following algorithms shift from neutral to bullish mode. Portfolio managers adjusting quarterly risk metrics start increasing their long bias. The market becomes a machine that pushes itself upward, using its own rules to generate more momentum. And here's the hook that defines the deeper truth: the most powerful market moves happen when people are forced to act, not when they choose to. At 67.3, this forced behavior becomes visible, measurable, and unstoppable. It is also the moment when hidden vulnerabilities start to surface. Positions that were quietly underwater become publicly stressful. Leverage that once looked smart becomes dangerous. Short sellers who believed they could push price back down realize that their window has closed. Every attempt to apply downward pressure becomes weaker than the last, revealing that the majority of strength is now on the side of the buyers. At this exact point, the market becomes a battlefield where momentum, fear, and automation collide. And once the breakout above 67.3 is recognized, the reaction is rarely gentle. It's explosive because the market isn't just moving, it's unwinding old positions, old assumptions, old strategies. This is why 67.3 isn't just a number. It's the catalyst where upward movement transitions into upward urgency. The moment where the market stops whispering and starts shouting. The point where the structure changes from resistance into acceleration, and from acceleration into genuine instability for anyone who bet against it. The moment the price reaches, and 67.3, the options market stops being a quiet side arena and becomes the core engine of volatility. This is where the hidden stress inside the derivatives world begins to surface, where call options that once seemed safely out of reach suddenly flip into the money, and where market makers, who are often invisible in normal price action, are forced to step into the spotlight and react. And here is the hook that drives the entire dynamic. When call options go in, the money, market makers don't get to choose what happens next. The math chooses for them. Options are not just bets, they are obligations. Every call option represents potential exposure that someone must hedge. When call buyers win, market makers lose unless they hedge aggressively. So when the price crosses the 67.3 threshold, a wave of previously dormant risk begins waking up. All those contracts that were considered safe by institutions suddenly become liabilities. The transformation from theoretical risk to real exposure happens instantly, and the response must be just as fast. Because once price is above the strike, the clock does not slow down, it speeds up. At 67.3, the Greeks, those mathematical forces behind options pricing, begin to sharpen. Delta increases, meaning market makers must buy more of the underlying asset to stay balanced. Gamma accelerates, meaning the higher the price goes, the more aggressively they must hedge. This creates a feedback loop that no institution can escape. It's the point where buying becomes mandatory, not strategic. And mandatory buying is the most powerful fuel any market can ever receive. This is why markets move violently at levels like this. Not because traders choose to push price higher, but because they are forced into it. Imagine dozens of market makers simultaneously requiring thousands or millions of units of the underlying asset simply to avoid being crushed by exposure they no longer control. That kind of buying doesn't enter quietly. It enters like a shockwave. And for short sellers, that shockwave feels like a rising tide swallowing their positions 1 inch at a time, then 1 foot at a time, then all at once. The psychology behind this moment is equally critical. Below 67, traders might still believe the market can be contained. But once the options market activates into full hedging mode, belief no longer matters, mechanics take over. Algorithms begin adjusting their risk models, volatility calculations shift upward, and market depth starts thinning as buyers become more aggressive and sellers more hesitant. This creates the perfect environment for explosive moves, because each upward step forces even more hedging, and every bit of hedging pushes the price further up. And here's the powerful hook. The options market doesn't negotiate, it dictates. Once call options flip in, the money, every institution handling them becomes a participant in the rally, whether they want to be or not. Their only choice is how fast they react, and slower reactions cost exponentially more. This is where the real drama unfolds. Shorts who were relying on sideways movement suddenly see a new enemy, one they cannot fight. You can fight traders, you can fight momentum, but you cannot fight the mathematics of delta hedging. Once the options market begins buying, resistance levels evaporate. Sell walls that once held firm get absorbed like they were never there. Liquidity that once looked sufficient becomes paper thin, and the market behaves like a compressed coil finally snapping upward. The most dangerous part of all this is timing. Once market makers hedge late, they don't just buy, they chase. And nothing destroys a bearish structure faster than institutions chasing a rising market out of fear of deeper exposure. This is the moment where panic begins behind closed doors, where risk desks start issuing warnings, where traders begin calculating losses not month to month but minute to minute. And all of it begins with one simple event, the flip of call options into the money at 67.3, the trigger that turns quiet risk into loud consequences and controlled markets into unstoppable movements. When a breakout happens right before a weekend, the market enters one of the most dangerous and unpredictable phases of behavior, the liquidity gap zone. This is the period where price moves, emotions shift, and institutional risk models begin recalculating without the stabilizing presence of real-time market participation. And when the asset pushes toward or above 67.3 before a weekend close, the stress on the system multiplies. Traders don't just see a volatile chart, they see the potential for a Monday morning that opens with fear, forced repositioning, and aggressive liquidity searching. Here is the hook that defines the entire danger. Weekend gaps don't forgive mistakes, they punish them. The concept of Monday panic is rooted in market mechanics, not drama. When a powerful upward move happens on a Friday, there is no immediate opportunity for short sellers, hedge funds, or market makers to act. They are left frozen in their positions for 48 hours while the world reacts, digesting the move, updating valuations, and adjusting expectations. And in those 48 hours, fear does something unique. It grows unchecked. Without live trading, without the ability to hedge instantly, without the ability to add liquidity to slow the rally, institutions are trapped in a holding pattern, and trapped participants behave very differently than active ones. As the price approaches that 67.3 threshold heading into the weekend, every fund holding short exposure must consider one terrifying possibility, that the market will open substantially higher on Monday, and they will have no way to soften the blow. That fear translates into defensive behavior, closing positions before the weekend, reducing exposure, and adding protective buy orders. All of these defensive moves create upward pressure in the final hours of Friday trading. The irony is sharp: the more they fear Monday, the more they push the price higher on Friday. Liquidity is the oxygen of markets. But late Fridays are known for thin liquidity. As traders reduce activity, institutions slow orders, and algorithms shift into passive mode. When a breakout occurs during this window, the upward movement accelerates with very little opposition. And because the market is thinner, every buy order, especially large institutional hedges, has a disproportionate impact on price. This is where volatility becomes less of a reaction and more of an inevitability. Now consider the mindset of large funds entering the weekend with underwater short positions. They begin calculating not the current losses, but the potential losses if the market gaps up 1%, 3%, or even 5% at Monday's open. These calculations force immediate decisions. Some funds close aggressively to avoid catastrophic Monday exposure. Others attempt to hedge through options, but with calls going in the money, that becomes costly and ineffective. So the only remaining tool is to buy the underlying asset, and that pushes the pressure even further. Here is where the hook intensifies. A weekend breakout removes the illusion of control from the hands of the institutions. During normal trading hours, they can fight back. They can place walls, suppress momentum, use liquidity to stall direction. But on weekends, they lose all tools. All they can do is watch and wait. This powerless state is the real generator of Monday panic. It is not the price itself that scares institutions. It is the inability to act while that price is moving psychologically, fundamentally, and globally. News outlets publish analyses. Social media amplifies speculation. Global commodity markets shift sentiment. Investors across different time zones form expectations. By Monday morning, the market doesn't open with neutrality, it opens with pent-up emotion. Once markets reopen, panic becomes visible. Institutions rush to adjust misaligned positions. Market makers widen spreads to protect themselves from volatility. Traders who closed early on Friday jump back in, only to face an even higher price. Short sellers who thought they could manage risk begin covering rapidly, creating a cascade of forced buying. This is the exact scenario where opening gaps become explosive, unpredictable, and often irreversible. And this is why the lead up to a weekend breakout matters so much. Because when the system loses its ability to adjust in real time, instability becomes not a possibility but a certainty. And by the time Monday arrives, the panic isn't created by the price, it is created by the pressure that was allowed to build without release. When a market moves into the zone above 65 and towards 67.3, something far more important than price begins to emerge: the gradual unraveling of the control mechanisms that institutions rely on to keep volatility contained. These mechanisms, algorithmic sell walls, liquidity engineering, tactical shorting, and coordinated resistance, are designed to maintain stability, or at least the appearance of it. But every system has a breaking point, and the most revealing moment in any market's life cycle is when the tools built to control it begin to lose effectiveness. Here is the hook that defines the entire story the moment control fades. Truth takes over. For institutions, control is everything. Controlling liquidity, controlling sentiment, controlling the pace of price movement, these factors determine whether they can manage risk or whether risk manages them. But as the price accelerates, these tools start to malfunction in subtle yet catastrophic ways. A sell wall that once held price steady now gets eaten instantly. A short position that once created downward pressure now becomes a burden. Algorithms that once worked in harmony now begin to conflict, some trying to suppress the move, others forced by design to buy into it. This internal conflict marks the beginning of systemic breakdown. As the asset moves into the higher range, the entire ecosystem begins to shift. Market makers can no longer provide the same level of liquidity without exposing themselves to unacceptable risk. Their hedging models expand unpredictably. Volatility pricing becomes unstable. Bid-ask spreads widen as market participants hesitate to be on the wrong side of the next surge. This widening is not random, it is the visible footprint of failing control. Short sellers, who were the backbone of downward resistance, now face mounting losses. Their strategies begin to invert. What was once a method of applying pressure becomes a source of pressure against them. This inversion is one of the clearest signs of structural failure in market control. The very act of shorting, intended to suppress price, now intensifies upward momentum when those positions must be closed. Every forced buy back becomes a spark, and with enough sparks, the entire structure catches fire. And here's where the hook gets sharper. A market loses control not when buyers become strong, but when manipulators become weak. Once institutions realize that suppression requires more capital than they are willing to risk, the illusion of dominance collapses. The market's behavior shifts from artificial stability to natural direction. And natural direction, fueled by real supply and demand, is far more powerful than any engineered sell wall. Another sign of systemic failure comes from timing. Institutions depend on precision, delayed reactions cost them money. But as volatility increases and the price approaches 67, 3 delays become inevitable. Algorithms lag. Liquidity dries. Positions that require fractional second responses fall behind. This lag doesn't just reveal weakness, it amplifies it. By the time institutions react, the price has moved again, often against them. Risk models begin sending internal warnings. Portfolio managers grow uncomfortable with growing exposure. Traders feel the pressure as their control level. Strategies begin breaking down. The entire atmosphere changes from confident execution to anxious anticipation. And once that psychological shift happens, the market gains momentum that no technical tool can suppress. The failure of control mechanisms also exposes the fragility of coordination. Institutions can influence markets individually, but true suppression requires collective effort. When one large player steps back or begins to cover their positions, the entire chain loses effectiveness. And once coordination cracks, each firm prioritizes self-preservation over system preservation. This transition is subtle but devastating. It transforms a controlled market into a reactive one. What makes this moment so powerful is not just the mechanics, it's the inevitability. When a market reaches this stage, there is no tool left that can fully restore control. Panic overrides planning. Fear overrides strategy. Momentum overrides manipulation. And this is the final hook that defines the nature of market breakouts. When suppression fails, acceleration begins not because traders choose it, but because the system forces it. At this point, the market is no longer fighting to rise. Institutions are fighting to survive the rise. And that transformation is the clearest indicator that the old structure has broken and a new phase of price discovery has begun. As we approach Monday, remember the world doesn't reward the ones who sleep on opportunity. It rewards the ones who stay awake when the world grows dark, the ones who observe the signals, the ones who move when others freeze. They tried to stop it at 65U, but destiny pushed it to 67. 3. Let that be your reminder that no ceiling is strong enough to hold back real momentum, whether in markets or in your life. Stay aware, stay prepared, and above all, stay rising.